So yes, ladies and gentlemen, it's my honor to introduce the next gentleman who's going to present a very, very special keynote address. I've been sitting in the audience, and yes, the word has been spreading through that we do not want to miss this next presentation. So ladies and gentlemen, presenting to you the Vice Chairman and CEO of HDFC, Mr. Keki Mistry. Welcome, sir.
Would you like a minute or two to... The topic I'm going to talk about today is on the Indian economy and the current real estate scenario in India. So, good afternoon, ladies and gentlemen. It's a great pleasure to be here today at Naredco's Real Estate and Infrastructure Investors Summit 2018. This year has been a year of unexpected challenges for the Indian economy. While structurally India is making tangible progress, global headwinds are throwing up temporary obstacles to India's economic growth engine. Globally, synchronized growth is no longer happening, with the US economy strengthening substantially, Europe showing moderate growth, and China grappling with a slowdown in consumption. In India, significant movement in oil prices will always have an impact on our economy as we import 80% of oil requirements. Recently, Brent crude prices crossed the US $80 per barrel mark due to possible trade sanctions against Iran by the US and lower forecasts on shale production. Creating further concern is the depreciation of the rupee, which had hit an all-time low by touching rupees 73 versus the dollar. Strengthening of the US economy, geopolitical issues, and trade tensions between US and China continue to put the rupee under pressure. These factors are making our stock markets endure sustained volatility. In fact, the rupee has been the worst performing currency in Asia, having depreciated by 12% year on year. Having said that, the rupee in recent history has been known to depreciate swiftly, followed by long periods of stability. The rupee follows bouts of depreciation once every 5 years. It happened in 2008 due to the subprime crisis. During 2013, after the taper tantrum, when the US Federal Reserve announced it would slowly pull back its quantitative easing program, and in the recent period, which has been called as the emerging market rout. Unfortunately, all emerging market countries are treated as a homogeneous group by investors in terms of risks. Many of the emerging market countries are showing signs of acute weakness due to their exchange rates depreciating against the US dollar. South Africa has entered into recession. Argentina is expected to be in a similar boat, and the currency crisis in Turkey is likely to severely affect its economy over the next 12 months. However, it needs to be pointed out that these countries have deep-rooted political and fiscal vulnerabilities, which is not the case with India. Former Goldman Sachs Chairman Jim O'Neill has said that India should not be regarded as just another emerging market, as it accounts for 3% of the world GDP. He further stated that the country is moving in a positive direction. India's immediate concern is its widening current account deficit, which is expected to cross 3% of the GDP in financial year 2019 compared to 1.9% of the GDP a year ago. Apart from high oil prices and a weaker rupee, outflow by foreign portfolio investors is a major concern. The other half of India's balance of payment, which is the capital account, is also being affected due to the slowdown in foreign portfolio investments and foreign direct investments. Hence, financing the current account deficit is an immediate worry. Measures have been announced by the Reserve Bank of India and the Finance Ministry to assure the markets, and according to the government, the first phase of measures is expected to bring in $8 to $10 billion. Some of these measures include easier access to external commercial borrowings for manufacturing companies, exemption of withholding tax for masala bond issuers, and reducing pressure of debt outflows by removing the cap on FPI's exposure in corporate bonds. Other announcements expected, such as curtailing of non-essential imports, which we saw happening yesterday, and measures to boost exports. In my view, however, India is not in any way in a state of doom and gloom. In the first quarter of the current financial year, India grew at a very impressive 8.2% of GDP, and we continue to be the fastest growing major economy. Strong growth in manufacturing, construction, and the agricultural sectors have propelled the economy to its best performance in 2 years. These trends indicate that India is on the cusp of a revival in the investment cycle. Green shoots are visible in sectors such as steel, cement, roads, and logistics. Capacity utilization is up from 71% in 2016 to over 75% currently. Global investors are aware that India remains a compelling investment story. The strong domestic demand, rapid urbanization, a young population, improved job opportunities, and rising aspirations puts India in a unique and advantageous position. Some of the key reforms are playing out, with the goods and services tax stabilizing. Many states have established the Real Estate Regulation and Development Act, which is the RERA Act, and the Insolvency and the Bankruptcy Code. Demonetization has not only increased the tax base, but has also helped in the financialization of savings. Increasing financial literacy and awareness, lower returns on other asset classes, such as gold and fixed income, has prompted domestic investors to increase their flows into equities. For instance, domestic institutional investors have poured in US $10 billion into equities in the current calendar year, compared to a net outflow of US $856 million by FPIs. Retail investors are also increasingly putting in their money in mutual funds through systemic investment plans. In financial year 2017-18, these systematic investment plans amounted to 67,190 crores, which is about $9.5 billion US dollars, a 53% increase over the previous year. In financial year 2018-19, and this is up to August, so it's about a month old, investments through these systematic investment plans have increased by 55% over the previous year. Underpenetration in the insurance sector shows that there is potential for future growth. All these factors are an indication that there is significant cause for optimism in India. Coming to the real estate sector, another area that generates strong optimism is the housing and real estate sector. The housing shortage in India is massive, we all know that. The central government has been at the forefront and has incentivized all constituents in the housing chain, be it developers, home buyers, or financiers. The government's Housing for All by 2022 program and the granting of infrastructure status to the affordable housing sector are aimed at boosting supply. The focus has now shifted to increasing the supply of homes at price points that are affordable for the middle and lower income groups. Several of India's large and reputed developers are building affordable homes, which augurs well for the sector. According to a recent report, launches within the rupees 40 lakh pricing bracket were highest during 2017 and the first half of 2018. Mumbai and Bangalore remain in the forefront for residential launches in affordable housing. Several property consultants have stated that the affordable home market currently makes up nearly 20% of residential property sales, compared to 8% during financial year 2015-16. Another positive is the government's vision to develop 100 smart cities holistically. The rupees 48,000 crore smart city mission is aimed at applying smart solutions to improve infrastructure and service delivery in cities. This will have a multiplier effect on the economy. It will drive the demand for affordable housing and generate new employment opportunities, as India needs to create a large number of jobs every year. The importance of cities can be gauged by the following two statistics. The top 10 cities in India are built on as little as 0.1% of India's land. They house 8% of the population, but they account for as much as 15% of India's GDP. Similarly, the top 100 cities in India are built on only 0.24% of India's land mass. 16% of the population live in these cities, but they account for as much as 43% of India's GDP. And thus, in other words, 0.24% of the land contributes to 43% of the GDP. Thus, by creating more cities, we could see a significant enhancement in GDP. The Smart Cities policy attempts to create large tracts of urban land that attract investment and provide sustainable, high-quality living standards for the residents. I do realize that the real estate sector has been going through a difficult time over the last couple of years. Several developers are facing execution delays due to a number of factors, including cash crunch and issues related to project approval. The real estate sector is amongst the most resilient sectors, with so many changes having taken place, including GST and RERA. The traditional business models of developers has been disrupted, and as a result, real estate companies are learning to adapt as they recalibrate to new institutional and structural reforms. A common factor affecting developers is the shortage of working capital and the high cost of funding land purchases. A common source of working capital for developers used to be the advance receipts from selling flats while under construction. This resulted in reducing the amount that developers needed to borrow. With the introduction of GST on under construction properties, home buyers now prefer to buy ready properties where there is no GST. Builders are therefore deprived of the working capital that they were earlier getting and hence need to borrow more money to complete the construction. This adds to the interest burden and consequently to the overall cost of construction. GST coupled with stamp duty puts additional burden on home buyers. The GST rate for under construction properties is 12% and in case of affordable housing is 8%. Stamp duty rates differ from city to city and state to state, but also can go up to as much as 7%. The combined tax burden could be as much as 19%. With RERA, small players could be affected, leading to some consolidation in the real estate industry over the medium term. RERA, however, will pave the way towards sustainable growth in the industry. Renowned developers with strong fundamentals will continue to do well. According to the rating agency ICRA, we are seeing an improvement in home buyer sentiments with a preference for established real estate developers with a proven track record. The benefits of the various reforms will in the long term prove to be very positive for the real estate industry. There are now better checks and balances to monitor the progress of projects. According to me, RERA will bring back the cycle of trust. A strong regulator ensures discipline amongst the entire developer community, which in turn gives confidence to potential home buyers. At the end of the day, confidence and trust are the key pillars. The implementation of RERA is a confidence booster for home buyers. Housing is the single largest investment a person makes in his or her lifetime. There have been numerous cases of customers being duped, endless delays, poor quality construction, customers not knowing the actual livable area that they are getting, or certain developers undertaking radical changes in building plans without the knowledge of the customer. RERA has ensured that a significant part of the development risk will shift to the developer as compared to earlier when a large part of the risk was borne by the consumer. We must remember that any sector or business runs efficiently as long as there is trust. Conversely, there is trouble and red flags get raised when mistrust sets in. The flooding of reforms in the real estate sector was really intended to restore that trust. I believe that the key roadblocks for affordable housing today is that the state governments and local authorities do not have a transparent and streamlined process for granting building approvals. There is an urgent need to put in place an online time-bound single-window clearance mechanism for fast-tracking the numerous approvals required especially for affordable housing. There is a need to incentivize state governments who fast-track approvals for affordable housing. The multiplicity of approvals required from different authorities, such as environment, civil aviation, and railways, has to be streamlined to help reduce timelines. We are now hearing that in Mumbai, building approval have come to a standstill due to confusion over the new development control regulations. Further, the BMC is not clearing construction permits till it gets clarification from the Supreme Court over the ban of the dumping of debris. I do understand that such hurdles add to the frustration and pain of real estate developers. With the strides that the government has made on digitization, integrating these approvals to one platform can be easily done. Once approvals are online, timelines can be transparently monitored. Also, majority of land records are outdated and need to be updated so that delays in approval can be reduced. There is a need to expedite the digitization of land records and the land title insurance process. Another issue I would like to mention is about how land funding can be made available at a reasonable rate. Since 2006, the RBI has prohibited banks and housing finance companies from funding land purchase. Funding for land is therefore done largely by private equity funds and some NBFCs who charge exorbitant interest rates. This increases the cost of construction and therefore the sale price of the product. If housing finance companies or banks of a certain threshold size are permitted to fund developers to acquire land for affordable housing, then the current high interest rates are likely to get rationalized. This in turn will help reduce the ultimate cost for a home buyer. I would like to reiterate that despite these hurdles, the sector has unlimited potential as the demand for housing in India is immense and insatiable. If one looks at the growth of housing finance in India over the last 20 years and compares it with India's economic rise, the success of both can be attributed to the structural changes that are taking place in India. For instance, India has favorable demographics, with 65% of its population being under the age of 35 years. India's middle class is estimated to rise rapidly from 250 million individuals currently to 800 million by 2030. Together, these two factors are fueling consumption and driving growth. Structural demand for housing in India will always remain strong because of a variety of factors, such as improved affordability, under-penetration of housing finance, increased government focus on affordable housing, and favorable demographics, increasing urbanization, and rising aspirations. A young population, growing nuclear families, and improving job opportunities has transformed the attitude of the current generation in India. Younger people want to buy their own homes, and unlike the previous generation, they are not debt averse. The under-penetration of housing finance indicates that there is still plenty of scope for the mortgage market to grow. Though mortgage penetration in India has more than quadrupled from 2% of the GDP in the late 1990s to 10% today, this ratio continues to remain low, especially when compared to our neighbors. China, for example, is 22%, US is 63%, UK is 68%. The trust on housing by the government, coupled with the demand for housing finance and the growth of the housing finance industry, has led to many analysts being positive about India. A report on housing by CLSA has projected that, driven by the impetus for affordable housing, 60 million new homes will be built in India between 2018 and 2024. From an investment point of view, real estate in India can offer long-term investors stable income streams. There are many emerging opportunities in both the commercial and residential sectors. There is also an increasing global investor interest in stressed real estate assets and real estate investment trusts, which are still at a nascent stage in India. REITs will ensure greater transparency, depth, and liquidity in the real estate sector. In fact, REITs will spur investment in commercial properties. The demand for commercial properties from IT and IT-enabled services, banking and financial services companies, and e-commerce companies continues to be strong, especially in cities like Bangalore, Hyderabad, Chennai, and Pune. Private equity funds will continue to repose faith in this asset class. Invariably, demand for office space is often followed by an improvement in the residential market. For instance, companies that take new offices on lease will hire employees. They in turn will require new homes for themselves and their families. Hence, the demand for residential properties keeps increasing. I have a few suggestions which the government may consider for the long-term growth of the real estate industry. I've discussed some of them earlier in my talk. These can be summarized as follows. First is fast-tracking building approvals. Second is availability of cheaper funding for land purchase. Third is rationalization of GST and stamp duty rates. And fourth is promoting rental housing. Economic growth is associated with a significant increase in rental market activity. However, in India, participation in the rental market is declining. There is therefore a need to encourage investment in rental housing. Many people are unable to afford buying a house and therefore need to stay in rented properties. There is therefore a need to incentivize investment in residential rental properties. The tax deduction available to the owner in respect of the interest payment is only rupees 2 lakhs under Section 24. Earlier, the entire interest paid was allowed as a deduction. This has made investment in rental housing very unattractive. Rental yields are 2 to 3% for residential properties. Interest rate is close to 9%, and therefore the investor must get a minimum 7% appreciation in the value of the property in order to make the proposition attractive. In conclusion, I would like to say that I have a positive outlook on the real estate sector in India. The sector has endured a number of unprecedented events, such as the liquidity crunch due to the after effects of the global financial crisis and demonetization. Despite bracing such storms, real estate companies and developers have always come out stronger than before. GST and REIIS are much needed reforms whose benefits will be visible over the medium term. The impact on government policies like the Pradhan Mantri Awas Yojana is gradually playing out across all major cities in India, indicating early signs of recovery in residential real estate. The India story remains optimistic. If one recalls 5 years ago, India was part of the Fragile Five, a fancy name given by analysts to describe economic turmoil in vulnerable emerging markets. Policies introduced in the last couple of years have led to investors taking an active interest in India. Last year, India has jumped 30 spots in ranking to the 100th place in terms of ease of doing business. With GST, it is expected that the ranking will further improve in the coming years. Surveys of global CEOs show that they already consider India as an economic powerhouse. India is also making steady progress in the corruption index by Transparency International. In the real estate sector, India is also inching up the ladder in JLL's Global Transparency Index and is now ranked 35th. According to JLL, India has emerged as one of the top 10 countries to register maximum improvement in transparency in real estate over the last couple of years. All these rankings are the outcome of the unambiguous trust by policymakers to push India in the right direction. When the intent is right, the rest automatically follows. India is striving to get its infrastructural and housing policies right by recognizing that it needs to invest in cities. India needs US $1.5 trillion in investments to bridge the infrastructure gap over the next 10 years. The India of today wants development, jobs and growth, and it is good to see that the policymakers are rising to fulfill its people's aspirations. Lastly, I wish Naredka and all the participants a very successful summit. I'm sure that issues concerning our sector will be deliberated over and key outcomes will be assessed to ensure that the housing and real estate sector goes on to become stronger, more transparent and sustainable. Thank you very much.
Once again, can we have a huge round of applause, ladies and gentlemen? Also, for a small token of appreciation, may I invite Dr. Niranjan Hiranandani to please come on the dais. And everyone, may I request all of you to give a standing ovation for such a fantastic. Mr. Keki Mistry, ladies and gentlemen, what an honor to have you amongst us, sir. Thank you for being a part of the Real Estate and Infrastructure Investors Summit.